Ladies and gentlemen of the crypto space, it's a Friday, April 14th at 11:28 a.m. and I'm back. I'm feeling much better towards the end of the week, enough that I need to vent. I need to get some content out about understanding this thing we call a system, financial markets, this thing we call money, and with the price action yesterday, post Post-Hapella. It's great time to talk about things that are interesting, things that are really exciting. And it's not that we are not respecting the catastrophic situation that many financial markets around the world find themselves in, but it's all related. You have a catastrophic situation here. How is it related to this market over here? How is that related to this market over here? How are all markets related together in this system of collateral, this system of risk-free collateral from a sovereign perspective, and how that has an effect on a capacity for one market to access funds and to use collateral to print money. Oh, I love that topic. So let's dig into the risks on this Friday and how these risks are going to affect our capacity to successfully navigate varying markets, and of course our market of choice, where I would argue, and many would argue, where the most opportunity exists from a global financial market perspective. Currency liabilities, collateral, and dollar printing. So we have big risks, and we want to always respect the risk. And let's go over here. Where is it? And Jesse has always he wasn't around in 2022, but he was around in 2020, and he always talks about the risks very nicely. But risks are all relative to what market, and that's what I like to express as so significant, the relative effect of risks on one market versus another. And clearly it's all related by the overall level of liquidity. Commercial real estate is quite stark, and how it compares to residential real estate is always meaningful to assess the relative degree of this risk. And it's the structure of the risk in the system is not the same as residential real estate in '08, but the risk is still there from a deflationary perspective, a currency deflationary perspective. And there's also the interventionist mindset, and what are the odds of different actors taking different behavioral courses of action, retail actors, commercial actors, and obviously regulatory action, and how all of these things play out is a manifestation of everyone's choice of action. And that's why it's so complicated to engage with markets, because we're sitting here as an individual actor and we need to assess, what the hell is this person going to do? What is that person going to do? Which overwhelmingly is the perspective that I've tried to offer over the last years, is how do I navigate all of these variables to find a stable and consistent path for me to execute personally? How do I interpret all of this data and not get overwhelmed? So I look at this data, I compartmentalize it, and there's plenty of other risks, particularly look at the TGA. Was it down to like $80 billion? The United States government operates on a couple of $1 billion a day worth of CapEx requirements. It needs to spend X amount of dollars per day. It has X amount of dollars in a bank account. It takes in X amount of dollars in IRS income from taxes. It's a business. And they're blowing through their cash. And they don't necessarily have a lot of cash coming in, at least as much as they may think, or they may hope, or they may expect. So there's complexities there, and the debt ceiling, and all this shit will drive you nuts. in the backdrop, I think the debt ceiling is actually interesting because once they alleviate that condition, they need to raise capital because they're running out of spending cash. And they have all these fiscal programs, and what was it, 20 something percent, 30 something percent more spending so far in Q1 compared to 2022? How are they going to finance all this shit? They're going to have to sell bonds. Selling bonds will. And who's the buyer of the bonds? The treasuries. Who's buying them? It's not international sovereigns, as Luke talks about of late. So, well, observe that the marginal buyer of U.S. debt has been the U.S. population. Talk about Ouroboros, where we're eating our own tail as general public participates in what some would argue is a sickness. Doesn't seem very healthy where we're buying the U.S. debt and the United States is financing all of our social programs, and we're literally paying for our, I don't know, it seems kind of sick. You sick bastards out there buying treasuries, that's some sick shit. So we're financing our own bullshit. So who buys them? How much are they going to have to issue? I can't believe they still have a debt ceiling. So if the U.S. buys our own debt, that dries up domestic liquidity. If we buy a $500 billion worth of, on the run, treasury auction, Treasury Direct, and the general public buys a $500 billion worth of U.S. debt. So what does that do? That takes those dollars out of circulation and puts them into the TGA account, and now we have the socialization of that capital, where the central authority of fiscal policy then says, all right, Treasury's got a shitload of cash. What are we going to buy today? Woo! Where are we going? We all going to Vegas? Congress going to Vegas? TGA just got refilled. We could spend some money. So, it's the relative nature of total liquidity in a market, and it's not as simple as people think. People have these horrible correlations between U.S. equities, international equities, and I hate that correlation with the crypto markets. And it's just not a U.S. market, and that's so important to really recognize now more than ever. With England, just Britain in general doing what they're doing over there, and how Dubai handles this type of market. They're interacting with this market directly. It's not a third party. It's not like in Britain they're going to interact with the New York Stock Exchange to interact with the crypto space. No, they're going straight to the crypto space. Which is why crypto is a market of markets accessible to all markets. That's why the entire argument of the SEC is such a joke, to regulate the crypto markets. It's like, are you going to regulate the British stock market also while you're at it? No, let the fuckers over in Britain handle the British stock market. Let the folks over in Hong Kong handle the Hong Kong markets. It's American exceptionalism, think they could regulate all markets, the arrogance to protect the American people. The inhibition of capital formation has been extraordinary. The fear the SEC has created is extraordinary. What a shame from a regulatory perspective and a financial perspective, for that matter. The products, the enterprise that can be created from this digital marketplace is meaningful in a systemically disinflationary system that we're currently operating in from a currency perspective. We desperately need more currency. Quite extraordinary. So currency liabilities is my favorite topic. And if they raise the debt ceiling and they're issuing these bonds. They can be used to create currency units. I mean, that's exactly what the Treasury would be doing. They're issuing debt and they're expanding currency by borrowing. Borrowing is the currency creation process. Um, I wonder where interest rates go. That's probably, a big consideration with what I've been talking about over the last couple months. If we go over to the U.S. 10-year, as yields come up, price point goes down, and we're in a structurally broken situation. Let me expand out to the 6 month because the monthly will drive folks nuts. I don't even look at that shit anymore. Who's looking at that monthly, weekly time frame? Albeit from a 6 month perspective, we've got some moving averages above head, but structurally, the trend break is obvious. So yields, what if they keep going up structurally? That means collateral price is cheaper. If collateral price is cheaper, that's exactly what I argue took the steam out of the DXY back in October. If you look at bond market volatility, volatility finally subsided in October of 22, which coincidentally coincides with not in the 6 months you see it, but if you go over to the monthly, oh shit, October of 22 is when the dollar finally lost steam. Why? Because collateral prices finally got cheap enough where you could use them to print dollar liabilities at a cheaper total expense than buying dollars on the forex market. This is the currency creation process in its finest, manifested by two peaks on two charts. Collateral stabilized. People outside of the U.S. are like, oh shit, finally, let's start to use these instruments for what their real value is to print dollars. And that's what we see. And I think structurally we're in a position where we may have long-term, relatively cheap collateral, especially considering how much they want to issue. For collateral prices to go up, folks in traditional finance are looking for a risk event. But structurally, a risk event is not part of structure. That's part of a transitory period where shit hits the fan and nobody wants to own risk. But structurally, how does this instrument fit into a functioning portfolio if over time collateral prices should be decreasing? Or not should be, but are now decreasing as compared to the last 40 years where they've been increasing. And that's change in structure of the collateral, the primary global collateral market, has a significant impact on forex market behavior. A return to the norm of higher collateral price over time, trending towards what? 0% yields? And then we're back to square one, what happened in 2020. The only way we don't have the malinvestment and the perversions of 2020, which is really the exemplification of post-08 financialization, is to have these higher rates of return on these collateral instruments, which means we have cheaper collateral going forward. And things don't go horizontal. Weight doesn't go horizontal. Price action doesn't go horizontal. Things trend in directions. And the direction that you see here has been appreciation. Yields going down as collateral pricing going up for the last 40 years. But structurally, it's not that anymore. So if the directionality changes here and collateral prices get cheaper over time, yeah, it changes the whole process of the banks and how they manage their balance sheet and all that complexity, and there's risks there. But if collateral prices are getting cheaper over time, that is favoring the rest of the world having a capacity to print dollars at a discount as compared to forex markets, which takes the power out of the forex market, which presents a variety of geopolitical considerations unto itself. But from a market and a structural perspective, let's go out to 6 month on the DXY. It's complicated because you have the relative central bank policy and everyone has their own story, and what's going on in Japan is quite different from the ECB. But generally speaking, I mean, the charts speak for themselves. Charts tell a story. So sure, we could digest the story of Japan versus Europe versus the US and where we are in that regard. But this chart kind of is the condensation of all of that into a single data set. And we see the buy pressure out of the dollar as compared to the yen and the euro, even considering the complexity of the story going on in Japan and Europe. Now, structurally, the dollar has been bullish since '08. That is a bullish trend. Higher lows, higher highs. And it's taken well over a decade to get from where we were to where we are. 70, and then this blow off. This from a technical, candles matter. You can't just say it's a candle. It's significant, the shape, the structure, because everyone looks at it. That's why they have significance. And that is a shooting star of shooting stars. We haven't seen a shooting star on the DXY like this. Maybe there's one back here in '09. That's such a look at that shooting star coming off of almost a decade of the dollar depreciation leading up to the '08 crisis. It was like a last disbelief that the dollar could appreciate, and there's all the reason in the world for the dollar to appreciate. That's another story, and it's like Brent Johnson's type ideology, and I agree with it 100%. But the world and capital markets and they operate in cycles, and structurally, this chart screams we're due for like a decade of dollar depreciation. And that doesn't mean you don't have the mega bull ripper and it goes to 150, 60, 70, 200, 250 as Japan's currency is printed to oblivion buying dollars, and that's all well and valid, the destination for the dollar. But structurally, for the system to continue, cycles need to repeat. And they have, at least since 1968. Structurally, the dollar will weaken over the next decade. As the dollar weakens, international liquidity conditions improve. You can inspect the total amount of currency units in circulation, but there's also the value of those currency units. So you can inspect the ECB balance sheet from a central bank perspective, the Japanese central bank balance sheet from a balance sheet perspective, but you could also inspect their currency units from a relative value perspective. So this chart speaks volumes about the value of foreign currency units generally appreciating over the next years. Now, obviously, over the next 1, 2, 3 years, if we see a structural breach of the TWAP to the downside, that's just going to confirm some significant outperformance of assets. Because as currencies get more strength, more purchasing power, they're able to buy more things. And then you could, obviously the conversation comes what assets and why people are buying what. But if you look back here at '02, that breach to the downside, how many, I love looking at the TWAP. And I love looking at these long-term time frames to understand the direction of markets. So a breach to the TWAP to the downside on a 6-month chart. Look at the amount of months of 6-month interval continuation. The breach to the downside back in January '03 was how many years of continued relative dollar depreciation? The same thing back here, back in '86. 1, 2, 3, 4, 5, 6, 7 is a decade of dollar depreciation following. So was it 2023, 2025, maybe like 3, 4, 5, 6 candles from now? 2025, 2026, we see a breach of the TWAP to the downside. The continuation is what interests me of directionality. It's not intraday, it's for traders, and that's okay. You can trade and look at the charts from those time frames and try and get ahead of market pressures intraday, intra-week, intra-month to capitalize on short-term volatility, intra-month short-term volatility. That's what I consider short-term nowadays. I like this chart too from a monthly TWAP perspective. Let's see what the 6-month looks like. So there's a long ways to get to the moving average on the 6-month. But if you go to the monthly, where are we? And historically, what did a breach of the TWAP on the monthly indicate? Now, we had a fake out in this year so far, February leading into, well, January leading into February. We thought it was going to breach to the downside. Now, historically, I don't know about bullish directionality and trends, but I like the TWAP in that regard. At least one, the average price over time, not necessarily all time frames. This is the time-weighted average price. So, trend reversal, and that would be a breach to the downside, a retest to the upside. So, look, it retested to the upside, and it failed. So the breakdown failed below the TWAP on the monthly, and then man, there was your blow off top. And that's what the banks. This was the banks of late. And now the volatility suppression, which is treasury market liquidity and all the things that the central bank literally is designed to do, smooth market function in the largest, most liquid market on the planet, the U.S. debt market. That's their job. Their job is to manage the volatility and suppress this volatility. But as you suppress this volatility with bond prices where they are, it's going to signal that the rest of the world is like, all right, game on bonds. What are we going to do with our bonds? Oh, sure, we could structure them part of place to park large amounts of capital for 3, 4, 5%. But folks, if the trend has breached from a structural depreciation perspective on bonds, it's a bit of an opportunity cost to have, and in an inflationary environment, it's not necessarily what folks want to do with the bonds. So to hold in a portfolio and focus on yields. If the yields are going to just keep going up, why buy them now? And so it questions a lot of what was normal 60-40 portfolios because bonds were appreciating. And you had the risk-off notion, so you could sell your bonds in a transitory risk-on fashion if shit hit the fan and the bonds just blew out to the upside. You look at this chart, that's exactly what 2020 was an exercise of risk on bonds. Bond prices went through the roof, almost to 0%, and everyone dumped the shit out of them. Look at this wick. What an extraordinary wick. So structurally, how bonds are thought of in a portfolio, I think, is changing because of inflation rates, consumer price inflation rates. And that's not necessarily controllable from a money supply perspective because we don't have control over the money supply. The Fed knows this. The Fed knows that they could barely control the money supply because how are they going to control someone taking U.S. bonds in Germany and giving them to a German bank and the German bank giving them a couple of basis points under face value in liabilities, and the liabilities are all transferable amongst the member banks of the integrated SWIFT system, and they're all integrated into SWIFT, so you can transfer liabilities all over the place, just as if they were actual dollars. So there is no difference between a dollar liability and an actual dollar, and the SWIFT system is completely complicit in the proliferation of dollar liabilities, euro dollars, actually being dollars. The prevailing currency unit is any currency that any liability that is transferable amongst member banks integrated into the global payments network, the SWIFT system. And let's see what the hell FedNow does. Oof, it's going to be quite interesting. So, overall, the kid shit in the pool. That's what volatility going up is. The Fed finally got control. Bonds got cheap enough where it took the steam out of the dollar, and structurally there's all the reason in the world for bond prices to continue trending upward over the next 5, 10, 15, 20 years. Paying the debt, servicing, that's another complexity. The Fed always says their role, Powell has said that explicitly in front of Congress, their responsibility isn't the paying of the debt obligation. That's Treasury and IRS and tax receipts and fiscal policy. The Fed's responsibility is smooth market function, normal market operation, suppression of volatility so the system actually works. So if the system continues in the direction it's heading, dollar down, relative purchasing power of foreign currencies up, which makes the rest of the world increasingly wealthy, asset prices up over the next 5, 10, 15 years, more currency units in circulation as the United States is forced to finance and raise more capital and issue more debt because that debt is dollars. There's more of those dollars than any dollar that the United States government has ever created. So more treasuries in circulation is more dollars in circulation. Dollar liabilities are dollars, which means higher asset prices. The entire trend, everything I look at from a macro perspective, is indicating over the long term, 5, 10, 15 years, higher asset prices, more currency units in circulation. And whether that's the financial economy or the real economy, as folks talk about, rightfully so, is another story, but how that contributes to consumer price inflation. But the problem with consumer price inflation is we don't have control over supply chains and manufacturing and productivity in the United States anymore. We outsource the shit out of it. So how that plays out over the next 5, 10, 15 years, reshoring, deglobalization. If we want to control consumer price inflation, we want to repatriate supply chains and deglobalize. So we're in control over productivity domestically. And that's how you control inflation, not restrict the money supply. If a person has a capacity to earn capital, fucking A. But they're trying to control a person's capacity to earn capital. Literally, that's the Fed policy is the labor market's too tight. Keep the interest rates a little bit elevated, 3, 4, 5%. That's the healthy place for interest rates. That cures malinvestment in many regards. Free money, cost of capital being zero, it's disgusting. So if anything, if they are able to stick to this, they're heading in the right direction. Everyone's looking for a pivot and decreasing rates. And I don't agree with that. What I want to see is asset price appreciation with higher interest rates, more debt issuance, and this all looks great. Everyone's looking at macro from a negative perspective. I think this looks great from an asset price appreciation perspective. That's the story I see painted in chart after chart. Structural trend, directionality on each chart tells that story. 5, 10, 15-year perspective. Where are things directionally pointing? Things don't just stop and reverse. They don't just turn around. That is one hell of a candle. 26 people in the stream, 9 likes. Thank you all. Click that like button. I appreciate it. Joe's in the house. Lord of the Pine Cones, good morning. Paul, Risky, Careless, One Curious, DXY is dipping. Well, bear in mind, look at this chart and the time frame, and I don't know. Is it dipping on the daily? On the 4-hour? I don't know. I mean, you got a little bump on the 4-hour. I can't stand this perspective. This perspective will just drive folks nuts. Let's look at the weekly. I mean, look at this structurally. If you zoom in on a weekly, I'm zooming in, guys. I'm looking at the weekly chart. Where are we structurally? A breach of 17 and 20 highs thus far has been invalidated. We are below it. We broke below in January of 23. We failed to hold above, even with a breach back above the TWAP. The TWAP held as resistance. It was rejected. We are now below. Double bottom. This is a position of weakness written all. I mean, listen, if you invert this chart, it's a position of support. So this is a period of the system trying to choose directionality, but this is leaning towards continued depreciation. Yeah, I don't need to hear daily, 4 hour, 1 hour where it'll push back up to the TWAP, or Japan is going to have to do some serious shit and devalue their currency. I don't need to hear any of that shit. Structurally, look at this chart. This chart screams it failed to hold 2017 and 2019, 2020 breakouts as support. And this was a long period because it broke out back in May of 22 and it failed. It is below that price action support, potential support, to flip a historic resistance. And we're talking historic resistances dating back 5, 6 years. That's where we are. And the dollar is the story. The dollar is the story of international liquidity. Because other countries, other sovereigns, all have their plans for the issuance of their currency, and your mind will go in circles trying to understand relative central bank policy, relative central bank size, and which currency is going to be stronger from a pairing perspective. But all that matters is that the world prices almost everything in dollars, and as the dollar becomes weaker, everything else has more strength. Therefore, they could buy more, and that means buy more goods and services and assets. And what assets are they going to buy? Assets that they have accessibility to. And look what happened with China. Chinese nationals buying large amounts of property in the U.S. and that's why the U.S. sold off good parts of our assets over the last how many decades at this point, because the dollar was cheap. Dollar went down to 70, 80 cents, and that increased the purchasing power of international foreign currency, allowed them to acquire more and more assets. And I think that's where we're heading again. That's a complexity from a geopolitical standpoint, from what is the best thing for America. If foreign currency units have excess power, they probably want some regulation, and we don't want to sell off the entire damn country. I'm a bit confused with interest rate swaps. I guess one side of the contract is betting on lower rates in the future. Well, interest rate swaps are basically just betting interest rates are going to go up or down. So you're able to lock in a fixed rate from a variable rate, or accept a variable rate from a fixed rate. That's generally speaking what an interest rate swap is. So if you borrow money against volatile collateral, and that means your interest payment is a variable rate, you're able to lock in a hedge with a fixed rate, so that you're converting basically that variable rate interest on the debt position into a fixed rate of interest. You're able to reduce the risk profile of that debt position. So that's the power of the interest rate swap. The significance of the interest rate swaps in the context of debt markets and leverage. I don't think that's the case for like euro dollars and how euro dollars contribute to general liquidity conditions. I think it's two separate parts of the global market. How interest rate swaps fit into the picture as a component that influences systemic stability. Shadow banks. Yellen's used that word, and that's just opaqueness. We don't know how their processes work, but I found it fascinating how a U.S. Treasury can be converted into dollar liabilities, and what is the risk profile if just hold to maturity? I want to remind folks like Tether and Euro dollars. Who gives a shit about redeeming a Tether for $1? If I post $1 million worth of uh, one year U.S. Treasuries, and I borrow 900,000 Tether, what kind of why would I be expecting dollars for my Tether? No, I posted 1 year Treasuries. I could give back my $900,000 worth of Tether, and I'll get my collateral back if that's what I really want. But this has nothing to do with dollars. I don't understand. The regulators definitely don't understand money if that's what they're thinking, where tethers need to be backed by dollars, because what if people are trying to redeem dollars? No, the tethers, if you didn't post collateral, you're not getting a fucking dollar for your tether. If you post that you have an account, if you have an account, you could pay back tethers to get the collateral that you deposited in an account. But if you just have tethers and you don't have an account with collateral that was posted, you're not getting anything back. This is an account. This is a debt account. This is a Eurodollar account. Doesn't that make sense how that would work? Dollars. I'm gonna go to Tether and give them $1 million. I want $1 million bills unmarked. What the fuck are people thinking? The business of Tether is a traditional business. It has to be, unless there's nefarious activity, as the truthers would argue. But from a functional perspective, from a traditional Eurodollar bank enterprise perspective, there's in the favorable case that it's a legitimate enterprise, it's a legitimate historic enterprise of collateral accounts. There's no magic. In fact, it's ridiculously simple for Tether to take absolutely no risk whatsoever and just rake in all the coupon payments on billions of dollars worth of U.S. collateral. There's no reason for them to take risk. It's just a legitimate, historic, traditional, simple enterprise. People didn't understand Eurodollars. People didn't understand it at all, and it's the currency that everyone uses. What a shame. I'm happy I understand that now in great detail. Would have saved a lot of headache if more understood that over the last years. Market called the Fed's bluff. Who gives a shit about the U.S. markets? The U.S. markets are perverted pig shit, and I'm not fond of the inflated state. I'm a value investor. I'm not fond of the P&Es. I'm not fond of the dilution and the lack of access to enterprise cash flow that these enterprises offer. I'm not fond of the risk associated with the subjectivity of human boards. I'm not here for people's fucking opinion. I can't stand that aspect of thinking about equities investment. It's like, ooh, that's a great board. Adding him to the board may boost the profitability of the company. I don't like it. I don't want to deal with people. People are a problem. They're a burden. They're unpredictable. They have their own subjective opinion. They have their own interests that they must fulfill. They're humans. And I don't want any of that touching my capital, touching my hard-earned capital. So there's so much risk, infinitely more risk dealing with an enterprise than software. So that's why my entire portfolio is structured accordingly. And I could underperform the market as much as someone would say. Yeah, how many folks from a more novice perspective would say curve is like, oh, that's cursed. It's a cursed asset. It was $6, $1. It's never going to go up. They don't understand. It's not meant to go up. It's meant to be stable, and the fact that it's stable is extraordinary, which is remarkable. It's protecting capital. It's protecting value. because it's stable. If it's stable and it's productive the entire time, 20, 30, 40% returns per year. Who gives a shit if it goes up in price? All I care about is that it's stable. People looking at the wrong thing with the wrong size, the wrong position sizes. Looking for multiples and risk and capital gains. And yes, yes, yes. I will partake in the capital gains along with all of you, especially our folks on Discord. When the time is right, when the excess liquidity is there. Let's take a look real quick. Digress into liquidity conditions. Kava over on uh, Cosmos Hubs. That's probably one of the few increasing liquidity markets, but it's relatively small, marginal, 156 mil. Overall liquidity conditions in the markets has been continuing to deteriorate, obviously stabilizing to a degree, but still marginally negative sum game, $71.45 billion worth of liquidity on Ethereum mainnet. I'll skip the other ones for now because they are all marginal. All your favorite L2s have marginal liquidity. They're small. Love you guys. Love the L2s. They're fun. They're fast, but they're small. They're tiny, and that's not where BlackRock is going to deploy an extra $1 billion and like finance liquidity vis-a-vis Ondo Finance and Archimedes and Flux, and they'll buy $1 billion worth of 10-year U.S. paper and vis-a-vis where's Ondo and their money market stable coins. Look at that. Interesting tech. So, and that's not going to an L2. That's not going to the risk profile of L2s. That goes to mainnet. And then that induces all the volatility associated with increased availability of liquidity. And the volatility produces what? Fees. Fees. I want to be the traditional intermediary. I mean, that's what all enterprise really is fees, is ROI, it's APR. You own a piece of real estate, your entire business reduces to an amount of APR on a yearly basis. If you get 3-4% on your house, I mean, it's pretty shitty compared to treasuries, and that's the big argument about George Gammon likes to talk about real estate very nicely. That video was about how it's just there's no reason to invest in real estate right now with 4 or 5% on government securities. So that's where liquidity is going to go. Mainnet, that's where the big money goes as mainnet continues to de-risk. I mean, now that you can withdraw capital, why wouldn't a large actor just secure the network and set up, 1 million validators? Just, take 20%. And then, yeah, I know there's the whole argument. Chris Black is completely right about you could buy a seat at the table. That's traditional finance, and it's not new. But that's why Bitcoin exists. It's part of the equation. It's part of the equation. There's still something significant here and meaningful, even if this is the traditional finance where you could buy a seat with capital deployment. Still something significant here because of the deterministic execution of immutable contracts. So that cannot be diminished, albeit that can diminish the availability of investment opportunity in the entire market. How much is immutable and deterministic? Well, it's all deterministic unless there's a malfunction. But how much is immutable? How much is protected? How much takes the human out of the equation from an investment perspective? That's the power of the immutability. Tapsy, hey, Paul, how were your taxes this year? Do you use the same service as last year? No, I use QuickBooks. I managed the balance sheet this year. I managed expenses versus income. I structured an enterprise, not as personal. The United States federal government loves to tax income tax, personal, especially personal income tax, and corporations. There's a variety of other structures like trust entities that have very different rules and regulations on how and when taxes are paid. Roth IRAs, you're not paying taxes yearly. But can you access your capital? What if there were structures where you have the tax deferral capability of a Roth IRA, but you had uh, ex, ex, expenses that are deductible and taxes? You might have income on a yearly basis, but you're not paying taxes on a Roth IRA. On a yearly, you pay when you take your capital out. So there's plenty of other legal structures that help with attributes like that are accessible for different reasons. And we've talked about that over the years. So taxes worked out very well. I execute my tax accounting in QuickBooks, and I manually manage all income with regard to reporting and documentation. I manage my expenses. I categorize them, and they depending on the expense, some of it, maybe all of it, is a deductible expense. My choice of structure. No token tax, VIP, none of that. I have no need nor interest in that kind of granular reporting. I operate as a balance sheet, and I avoid capital gains. I had almost zero capital gains in all of 22. All of 22 was an income and capex, and you could have looked at my tax report and be like, "Is this a business?" Literally, it was all like a traditional business balance sheet, and how it reduced at the end of the year. Hope that helps. Kill us, yes, a shame. It's embarrassing for the country. Yeah, so many things are, but it is what it is. You do the best you can. We have to think about ourselves personally and navigate all this shit the best we can. We have something similar to Operation Choke Point going on here too. Banks won't let you send money to exchanges to protect you from fraud. Well, Capital N is complicated. Obviously the story I tell is not from like a new investor perspective most of the time. If you had I made my capital in the crypto market, so that gives me great comfort with the capital I have in the crypto market. So I don't think from a deploying capital into the crypto markets perspective. I haven't deployed capital to the crypto market since late 2019 at this point. It's just capital out from functioning enterprise. So I don't have too much to say about sending money in, unfortunately. Or maybe that's fortunately, and I'm grateful that that's the case. Capital just comes out. So I appreciate the choking off of liquidity flow from capital in versus capital out, reporting requirements, KYC, tax reporting, and all that shit, all these complexities. But guess what? It's just like gambling, and it's regulatory arbitrage, and capital will find a way. If there's collateral, someone's going to borrow against it. And if there's risk-free collateral, someone's going to print dollar liabilities against dollar risk-free U.S. collateral. You could even do euro dollars with state debt. When's the last time a state has declared bankruptcy? That's the risk profile of that. And then, so I don't know what the point is of that thought. The point is, next question. That's the point. Careless is ridiculous. That's right. The laws protect us. It's all BS. It's all BS. Well, they want control and organization and order, and they want things to fold into the regulatory framework so that their profession, Gary Gensler's profession, has a purpose and its meaning, and it all makes sense in the way he does his daily business. And he wants not something that's outside of that. He just wants it to be part of everything he does on a normal day-to-day basis. And that's understandable, but the perspective is limited, and he cannot do what he wants to do because he has no control over Hong Kong markets or Singapore markets, which is the same crypto market that he's talking about regulating, but it's over there And just because it's over there, it has absolutely no jurisdiction of U.S. markets. And clearly over there, they're going to be considerate of U.S. regulatory policy, but there's going to be countries that are like, who gives a fuck what they're doing in the U.S.? We're going to do this. I don't give a shit that they have policy regarding Bitcoin. We're in Singapore. What does it matter? It's the same Bitcoin. You can't do that with the New York Stock Exchange or things that the New York Stock Exchange gives access to. If you're in Singapore and you want to engage with a U.S. business, you might have to go through the New York Stock Exchange to gain exposure, which means you have to go through regulatory policy. But if you're in Singapore and you want to gain access to Bitcoin, you don't have to do anything with the United States regulated infrastructure. You don't have to go to the New York Stock Exchange to get the Bitcoin. No, you're going from Singapore directly to Bitcoin. So what the fuck? U.S. SEC policy means nothing in Singapore. I'm singling out a country, but you get my point. Sir Joe, a pleasure. One curious. Don't remember regulatory protecting my capital when stock market equity went to zero. I put $250,000 into Nemaska Lithium back in like 17, 18. They had $2 billion worth of financing and everything looked lovely. And Pallinghurst came in with their hostile takeover and how they disrupted the local labor market. Oh, that was such a malicious attack. It was such a corporate attack. And Nemaska that raised $2 billion went bankrupt. Motherfuckers. I was not protected for shit. That was $250,000 down the drain. Kill us exactly. That's right. Ryan, hey, no, I'm trying to deposit into Try Crypto. I have balance, proportion, keep saying error message. There's a variety of reasons. That's a technical support type question. I don't know. Try Crypto mainnet. You watch your position size. There's no point in depositing Bitcoin, Ethereum, or whatever the stable is. I don't even know at this point. 3 curve. It's probably, but yeah, maybe a couple $100,000 in that type of position is meaningful from a mainnet perspective. $500,000. And then you could get a couple of percent return. You might as well deposit those LPs over in Convex, but you're talking about a couple of percent return on a Try Crypto position. And maybe you could leverage from an AVA perspective, leverage Try Crypto. But what are you going to get? 15%? 15, 20%? It's not worth the exposure. You might as well have spot exposure, and then you have long exposure. You don't want the impermanent loss. Albeit the impermanent loss will be muted from a Try Crypto perspective. You're exposed to both Bitcoin and Ethereum, stabilized dollar denominated. But personally, I would have no interest in providing liquidity under my current circumstances. Size changes everything. $100 million portfolio, and you're taking 20 mil, and you're getting 10% with low leverage on Abra in a Try Crypto. That's interesting. 10%, 20 is 2 mil a year. Income is income. 10% is outperforming the risk-free rate. So portfolio size makes all the difference. But otherwise, mainnet's restricted. Transaction fees is not going to be very profitable. Portfolio size, as much as I talk my stories about global macro and how all this shit is going to play out, capital management, like an investment advisor, is a different perspective, different types of conversations, and I've tried to fold that type of conversation into my dialogue over the years. I've gotten much better. I feel much more comfortable talking about different portfolio sizes. Now, honestly, with smaller portfolios, you are much more restricted in the types of activities you can engage in. It is much harder to make any capital with less money. Larger amounts of money make more money. It's the way it is. Capital concentrates. Munger said it the best. You need your first 100 grand. If you do what you can to get to your first 100 grand, and if you just look up the quote, Munger, 100 grand, you walk and you sell your car and you take a bus if you have to, and it takes 4 hours to get to and from work. Whatever. You do what you have to. And I'll put that on the shoulders of Munger, who said it. But if you're working with 1, 2, 3, 4, 5 grand, you're probably making mostly mistakes in the crypto markets, in permissionally accessible markets. Most people lose all their money in the markets unless you have different a non-standard contrarian methodology that you're executing, and most of the methodology that I talk about is not applicable to smaller portfolios, and that's unfortunate, but it's true. Um, Most smaller portfolios, wow, I just totally pivoted into financial advice, and that's fine. I'm more than comfortable providing financial advice nowadays. But smaller portfolios are going to be relying on capital gains, which requires technical analysis skills, and that's fine. Follow RT on Twitter. He's got to be one of the best technical TA guys. I mean, RT, follow RT. Follow Random Task 555. He's got to be one of the best TA guys I've ever seen. He's just wonderful. So smart. And you're going to need to get your TA game to another level if you have a small portfolio, because that is, oh my God, wrong portfolio. I was going for this. Here, right portfolio. Get your TA game to another level. And that's how you're going to be preparing for market conditions to come. So what would I say for a smaller portfolio? Find your way over to Arbitrum. Arbitrum is the playground of choice. Trader Joe has the vast majority of liquidity. And if you go over here, you can see that on Arbitrum, you're going to want to play with GMX. Where's Trader Joe? Volume, not TVO. I don't give a shit about TVO. Trader Joe is 597 mil. That's good to see. But look, Curve, even on Arbitrum, Curve's got 264 mil worth of oh, no, that's all. Sorry. Trader Joe, 31 mil. What the hell is Zyber Swap? But Uniswap, look at that, $444 million worth of activity, down 33% for the week. Focus on technical analysis from an Arbitrum or optimism perspective. Optimism has less liquidity. Arbitrum, where are we with liquidity? Down 12% for the volume. Sorry, liquidity, stables. I'm clicking a lot of stuff quick. And we go over to Arbitrum. Marginally up. Capital inflow of $36 million today. That's good to see. This is a great playground from a technical analysis perspective. Follow RT, learn TA, find breakouts, swim with the sharks, and that's how you turn a couple of $1,000 into 10, 20,000, 10, 20,000 into 50, 100,000, and you could do very well with technical analysis, and you could make a lot of capital. You're going to be putting in the work. You're going to be busting your ass, and wow, I just totally really digress, but I think that's important for folks to hear, wanting to take advantage of relatively high volatility markets that are starting to show signs of life once again. Daniel, is Curve better or Fracshare in your opinion? Better is a word that I don't like to use, my friend. It's not an easy conversation to start at this point. Topic for another day. KG, I see you're testing tapioca. Speaking of immutability, tapioca is a big deal. Where do you see tapioca? Yeah, there you go. Oh yeah, this is fun. This is lovely from a testnet perspective so far. They've done some incredible things. I very much look forward to this protocol doing what I think it's going to do. And from a VC perspective, from an enterprise ownership perspective, it should produce 10, 20, 30, 40, 50% returns. That's my general target. That's an entire conversation that's geared from an investor perspective, a venture capital perspective. To allocate capital like a venture capitalist. which is not what small actors can be doing. You're not buying and holding. Buying and holding, you need technical analysis. You need to be trading. You can buy and hold 100, 200, 300, 400, 500 grand. And if you get 5x over the next 10 years on 500 grand, you probably did fine, especially if it's productive assets that went 5x over a period of time. But if you're looking for 100x on $1,000 over the next 5, 10 years, you're not necessarily going to find yourself in a position where you're looking forward to being. If you make 100 grand in 5, 10 years, it doesn't change much at all. You need a process, you need a business for yourself as a business. You can be a trader, but you need to hit the technical analysis. Find that first 100 grand, as Charlie Munger says. Loved your talks on Twitter Spaces the other night. Keep schooling us youngins on the macro markets and how money flows through the system. So understanding money is how you understand investing, and there's different types of investing. And as I said, I'm a venture capitalist at this point, and I will be partaking, obviously, in capital gains when time is right. And I prefer to wait for very favorable conditions where I have like an ascending triangle that's like, oh shit, it's been an ascending triangle for 2 months, and when it breaks through, you're going to have a significant amount of buy pressure. You have the gamma flip, and boom, it's off. So, yeah, I like operating easy. I like operating less work. I like taking less risk. I will underperform more aggressive risk takers, and that's okay. I'm okay with that. Painful truth, yes, indeedy. Loki, great advice for learning TA. Check out RT. I hope that helps. You want to be methodical. You want to be rigorous, robotic. You execute this under this circumstance. A, B, C, D, processes, procedures, rules of operation, entry points, exit points, and that is how you turn smaller accounts into larger accounts. You protect your capital ferociously. You cannot lose capital. You need to gain it only, which means you need liquidity, depth. You need to know who the vested interest is. You need to know what other actors you're playing against to understand the field of battle, who the predators are. And then you could yourself be a little predator with $1, $2, $3, $4, $5,000 positions. KG, read docs. Blockmates is ridiculously awesome content. Definitely shout out to Blockmates. Ridiculously awesome content. Killis, we understand concepts too late sometimes, specifically how we focus too much on price when we forget the advantage of the multiples of percent returns per year on some of these platforms. Multiples of percent. Folks will see 100% APR and they'll deploy capital. And it's so important to put time frames into perspective, and that's why I talk about like monthly time frame, min nowadays 6 months, and I'm talking about like 3, 4, 5, 10-year type of perspectives. 100% APR seems to be very attractive off the cuff. It's like 100% APR, you're not going to get that anywhere, but 100% APR on a $1,000 deposit, you're probably doing the wrong thing. You're wasting time, you're wasting transaction fees, you're not going to get the returns you're looking for, and you're not going to save your way to some sort of goal that you have in mind. Trading is reasonable in that type of portfolio size, but you need to become a warrior. You need to become skilled, and that means you need to listen to the professionals. And that's not copying. That means you need to play on test nets, you need to practice, and you need to play on low fee chains, arbitrary optimism. You need the volume, you need total liquidity availability, you need to understand what money is so you understand when you should be looking at these types of environments for outperformance, so you look at your stable coins. And you look to see if you have an influx into Arbitrum. Now, Arbitrum capital flow in has been declining, so I think the opportunity is relatively drying up. And we'll see that with price depreciation as the large actors are selling and capitalizing on all the recent activity, and they're taking their money back to mainnet for where they're protected. No one's going to keep 100 mil just sitting around on Arbitrum. They're going to take it and take it off chain. Back to safety. All right. All right. I hope that helps. This is a large, diverse conversation. Collateral, money printing, risk, opportunity, personal capital management methodology, whether you're a venture capitalist or taking advantage of capital gains from a surgical perspective. So we cover a lot of bases with the content we discuss. And, I think that's important. And I know it's complicated to digest all the stuff that I talk about, but there's a lot of folks that need more well thought out advice. And I want to say the things that could have an impact on one more person to do better. And that gives me a little bit of hope, a little bit of purpose in my life. If folks could do a little bit better, because it's pretty shitty out there. So this is my way of feeling like I'm giving back a little bit, I guess. Thank you all. Thanks, KG. Thanks, Killis. 32 people in the stream, 15 likes. Click that thumbs up button. Makes me smile. Friday, April 14th, 12:35 p.m. I wish everyone a wonderful day. Be safe over the weekend. Watch your risk profile. Tell everyone to subscribe. After party on Discord for the most rational community in the entire crypto space. Links in the description as always. I will catch you next time. Peace.